Daniel, I go to this chart again. I talked about 5-year yields at the top of the show. 2-year yields is the other front where we saw quite a bit of repricing, up 25 basis points to 4.315%. How much more adjustment is going to take place in this asset class?
Well, when I look at this number initially, I thought that, it's going to be a glass half empty kind of scenario, right? The Fed needs to do much more in order to bring the numbers down. But if you look deeper into this, okay, the job growth blew out, but then the wage growth was pretty much flat, right? It's up 30 bips month on month, and the prior month was up 40 bips month on month. So you're having a scenario where the job growth is actually decoupling from the wage growth. And that kind of, echoes what we're hearing at the FOMC press conference, where Powell is increasingly open about the fact that, the Fed may be able to bring down inflation to its target, but without a crash in the job markets. So if anything, if you look at this from a glass half full angle, that, we may have a correction in the growth numbers, but we may not get as bad a recession as we thought it would have been, right? So
right. I mean, look,
it's natural for
Daniel, you spend a lot of your time debating the opportunities within the equities world. I've got a risk-free rate at US 2s that are giving me north of 4.2%. Where do you tell clients to go in light of what you're seeing in earnings or what you're hearing from the Fed?
Well, looking at what we're seeing in the earnings and what we're seeing right now, it seems that the S&P index may have a little bit more room to go at this moment in time, at least for the short term, right? So it broke about 4,100, and we saw some pullback on Friday, of course. But it is very natural for that to retest the new support at 4,100 and perhaps go higher. We're looking at around 4,325 as the next resistance. And if you look at some of the growth names, they're actually looking better. NASDAQ is actually looking better than the Dow right now. NASDAQ, perhaps has a little bit more room to go. So, this could bode well for U.S. equities in the very short term.
How do you balance exposure to China equities? I mean, of course, much closer to home for you in light of the geopolitical tensions over the weekend. Is there a stronger case or a reduced case for exposure to China stocks?
Okay, it's very rich right now, these few trading days. There's a lot of things that are happening. So in terms of what we're seeing in Hong Kong China equities, if you look at the Hang Seng Index, before Chinese New Year, it has been going higher, but it hit a resistance at 22,700 with very little volume. Okay, so the power to drive that index higher has already been weakening, even before this saga about the balloon. Okay, after Chinese New Year, when you come back, you're seeing some, quite a bit of selling pressure in the Hong Kong China equities and bearish price action, opening highs and closing the lows for a few days. And today that broke below the 21,380 support. So what is happening is that the money has been flowing back to the US, right? The earnings season was not as bad as what people thought. Okay, and of course the Fed was relatively dovish, etc., and the economy doesn't seem to be going into a hard recession, right? So all this means that US has more room to go. Hong Kong, China, probably you'll see the Hang Seng Index going back to 20,000 level.